Do you know that LLCs have flexibility in how they're taxed? That flexibility, with the right guidance, can save you money, but you have to know how to use that flexibility. In this video, I'll break down the different tax structures and classifications available to LLCs so that you can pick the right structure for you to maximize your tax savings.
LLC taxes don't need to be complicated. A single member LLC really is easy peasy. It's a disregarded entity for tax purposes, and all of the income of the company is just going to show up on your personal tax return or be reported on your personal tax return on a schedule. There's no other filing to do. It's very easy to do that. There are more complex strategies or more complex tax elections that your LLC can make. And they go from a partnership return, which is not very complicated, to an S Corp, which gets a little more complicated, to a C Corp, which gets very complicated. With these three types beyond that disregarded entity, there's certain times in a company's life or in its income stage that one of those status may make the most sense for you. You don't need to be afraid, okay? You can change the tax status of a company really almost at any time. There are some rules around that, but almost at any time you can change the tax status. Our recommendation for most is to start with the easiest, the most simple tax status for your company so that you can focus on growing the company. For a new startup, that would be for a single member LLC, a disregarded entity. And then if it's more than one owner, then at that point it would be a partnership. Hold off on those other elections until a later date. And if you think you might benefit from them, which we can talk about later, then you're going to need to talk to a tax professional to run the numbers for you to see if it makes sense. I like to think of LLC taxes as if when you go to a restaurant and it's a fixed price menu and they say, choose one item from column A and choose one item from column B. Column A is going to be what type of entity you're forming. Are you forming an LLC? You're forming a corporation? In most cases, those are going to be the choices. And then you have a choice, what tax status would you like for this company? And you do have the power to choose your tax election. The simplest tax election, and it's a default tax election for most people, is going to be what's called a disregarded entity. You're the only owner of the LLC, and the LLC, it has one owner. It's a disregarded entity for tax purposes. When you apply for an EIN, the default designation is going to be a disregarded entity. So what does that mean? No filing. The LLC from a tax perspective is disregarded. It doesn't exist. It doesn't mean from an asset protection perspective, it doesn't exist. The asset protection is there. It just means there's no separate filing that needs to be done for the company. It's all going to flow on to the personal return of the owner of the company. It's going to go on a schedule of the return. Depending on the type of income it has, the schedules vary, but there is no separate filing. It's integrated into the 1040. Disregarded entity tax status worries some people. They worry that they're not going to get asset protection, that it's going to be disregarded by the courts. It's not the case. It's disregarded for tax purposes. Okay? You don't have to file a separate return for the LLC. It still needs to be reported. You want to have this treated as a business because there's a lot of benefits of being treated as a business, but you only need to report it on a schedule of your personal tax return. It's not a whole separate full-blown return, not very complicated to do. And most tax software is going to ask you, did you have any business this year? How did you run it? And it's going to be very simple to file the information with the IRS and the state authorities correctly. And so you don't have to worry about the complexity if you got a disregarded entity. The next most common type of tax election is a partnership. And this is the default election when there's two or more owners of the LLC. A partnership has to file a partnership return. It's a 1065 return, and then there's likely a state level partnership return that also needs to be filed if there are personal income taxes in that state or business income taxes charged in that state. And that partnership return effectively is a Vegematic. You may not know what a Vegematic is, but it just splits the income of the company into the pro rata portions for each owner. There's no taxation that occurs at the partnership return level. It's a Form 1065. The partnership then issues K1s, 50% to Mary, 50% to Margaret. They then put those on their personal returns. Those K1s go onto their personal returns. You could also choose an S Corp election. S Corp says the owners must receive a salary. And that reasonable salary is a point of contention among many, and especially the IRS. And then the remainder of the income above that reasonable salary is distributed out to the owner free of FICA tax. So that Social Security and the Medicare and Medicaid, there's potentially tax savings with having an S Corp election or making an S Corp election. However, you do have to run payroll, right? So the IRS does look for the W-2 salaries to be issued to the owners and potentially others. The final election type is going to be a C Corp election. A C Corp files a Form 1120. That Form 1120 says, okay, how much did the company make? What were its deductions? Whatever's left, the company itself has to pay taxes on. That's the difference. A C Corp pays its own taxes on its own net income, and then those become retained earnings. An S Corp does not pay its own taxes. Everything goes to the owners. A partnership does not pay taxes. Everything goes to the owners. And then a disregarded entity, no taxes. Everything goes to the owners. So that really is, in a nutshell, the different tax elections that an LLC can make. Not all are going to be available to you depending on how many owners there are and a lot of other factors. And so when it comes to an LLC and taxation, we highly recommend you speak with a tax professional and understand what your obligations are going to be in terms of record keeping. Most accountants have sort of a primer they can give you to assist you when you're starting your new business. If you take anything away from this, ask for help. Get professional assistance when it comes to the taxes for your business.
Understanding LLC taxes is key to keeping your company compliant and maximizing your tax savings. But what about if you have multiple businesses or multiple assets? You're involved in many different ventures. That's where a holding company can be a real benefit for you. Let's dive into how a holding company could both simplify your tax situation, maximize your tax savings, as well as protect your assets with an additional layer of LLC protection. Watch the next video to find out how you might be able to benefit from a holding company structure.